Hey everyone, welcome to another weekly call. Super excited to have this one today. As just going to remind a few housekeeping stuff, and then we'll dive into it. Uh, as a reminder, we do these calls every week. The goal is for us to be better, smarter investors, wealth owners, and just smarter overall. So that's why we do this. We're going to share it afterwards on YouTube, Spotify, Apple Podcasts, and all the above. But whoever's listening to the recording, it's always much more fun to join these live. And if we're already here live, I will remind you guys, this is not a webinar, okay? This is not something where we just talk and present and you guys shut up. This is you guys, please ask questions, unmute yourselves. Feel free to ask the difficult ones as well. I know we're going to have some difficult ones here, just the three of us, but please feel free to unmute, chat, and all the things you guys are used to. So, without further ado, we want to welcome Sarah Shores here to the weekly call. Sarah will give her own background, but we're super excited to have this conversation because it's going to give us a whole new perspective of how to look at the investing world. I think sort of like if we look at the spectrum of like publics versus privates, Mike has always been very, you know, privates, not publics. I'm somewhere in the middle, and it's exciting to have someone on the far other side of it, the public side. And so this is gonna be an interesting conversation. I'm gonna hand it over to you, Sarah, and yeah, shoot away.
Great. Thanks for having me. Great to be here with all of you guys. So I'm Sarah Shores. I have 30 years of experience inside the institutional asset management industry, including 20 years at BlackRock, where I was a commercial leader for a variety of investment teams. I led our factor investment team, was the head of commercial strategy for our systematic active investment team, and then most recently was the head of product for the firm's entire active platform. So that's around 2.8 trillion across equities, fixed income, multi-asset, and hedge funds. I left BlackRock about a year ago, and now I run my own advisory practice helping asset managers and asset owners, wealth tech companies design the products, narratives, and go-to-market strategies to grow their businesses. Now, all the things I just talked about are focused on public markets. However, a big part of BlackRock's ethos, and indeed my own team's focus, had been really trying to transcend asset classes and understand the intersection of public and private. And we'll talk a lot about that today.
Awesome. All right, cool. This is gonna be exciting. I'm really excited for this conversation. So we had a pre-call, you, me, and Mike, a couple of days ago, and we talked about sort of how you generally see the financial industry and managing portfolios. And it doesn't matter if you're a trillion-dollar institutional or if you're a multi-million dollar individual or family, the fundamentals of portfolio allocation and managing finances, I won't say it's the same, but it stems up from the same similar fundamentals. And we talked about sort of the truths that you see that we all should pay attention to. And sort of, you know, I want to dive into that and understand like if you have five truths, and I said we got to focus. We're not going to have time to go through all the five ones. Let's talk about the first three. So can you give us like a high level, overview of the way you see it and when you were at BlackRock and today in terms of those, like, what do you think is important to how to look at the markets from an institutional lens and what we can learn from that?
Yeah, absolutely. So I was like trying to think about what can we take from institutional best practices that are relevant to every investor. And I think and let's put taxes aside because most institutions don't care about taxes. They're obviously of great importance to individuals and families, but I'm not going to talk about taxes much today. The three most important truths that I wanted to highlight are: one is that you own a portfolio, not a collection of ideas or a collection of investments. Second, that diversification is probably the most important thing that you should spend your time on. And third is that liquidity is generally the catalyst for all crises and where most hurt comes from. And so I would love to kind of dig into each of those in a bit of detail and kind of take questions and comments from the group as we go, thinking about those three things as being really where, as an investor, you can gain the most utility by spending time and attention.
Yeah, and I think the first truth really resonated because Mike and I have been walking through and helping other investors go think about investing. And I think the whole you have a portfolio and not a group of assets is good because we all go and look, hey, is this a good GP? Is this a good operator? Is this a good deal? And it might be an amazing opportunity, but wait, does it match what I need in my portfolio at the moment? And so I really resonated. But when you think about like like when BlackRock thinks about adding, like obviously it's huge positions, but is the overall goal a similar goal to that of an individual investor in terms of like thinking about adding to an asset allocation and comparing what I need in my portfolio versus what's currently in it?
Yeah, it should be. And I'll tell you, a lot of institutional portfolio managers, I think, fall prey to the same temptation of you're here to diligence a business or a name or a bond, and you're really focused on picking the best investment opportunities. It's really easy to lose sight of what is the sum of all of those parts. But it is, at the end of the day, the sum of those parts that drives what your annual cash flows are or what your total wealth generation is. And so looking through those individual investments to understand the sum of parts is really important. And in fact, you've seen a lot of the world's largest institutional investors announce that they're moving more towards this total portfolio process, where instead of saying, Mike, you're in charge of public equities, and Latan, you're in charge of private equities, and you boys go pick, in your own ponds what you think is best. They're thinking at the total portfolio level, what is the best investment that I can make, and understanding the totality of all those things. If you've picked 40 individual investments, and for the sake of ease, we can say 40 to 40 stocks, you've largely diversified away the idiosyncratic risk of those individual names. So what are you left with? You're left with the commonalities across those securities. So in public equities, that's things like industries or geographies. And so, the first thing is, yes, we should think about what are those commonalities within an asset class. And you might be thinking about diversifying across vintages, geographies, sectors, business models, things like that. What I think fewer people think about is what are those commonalities across asset classes? Because ultimately, there are a lot of things that are common across asset classes. If you are still holding on to that concentrated, highly appreciated stock position from your last job, and you've got some venture investments, and you've got some real estate investments, and you've got some private equity, what you really have is one big bet on the strength of the economic cycle. So the first question to ask yourself is, what is the totality of what I have? What have I diversified away, and what is undiversifiable? And then the second most important question I think you can ask is, what is the best investment that I could make that is perhaps less reliant on the strength of the economic cycle? Because that's probably the most diversifying thing and the highest utility that you can do for yourself, is by introducing something that has still an attractive return, but less correlated to the economic cycle.
And what is something like that? Because it's hard for me to think of like what that really is, because it feels like everything I would invest in is, reliant on the
You're a
economic
growth
cycle
guy. Yeah.
going well. Yeah. Whether, yeah,
Well,
whether it's
so
cash flow, because the things that I'm putting in for cash flow or appreciation or whatever it is, they all are dependent on the economic cycle going well. So what are some of the ideas that you would have for us to layer in something like that?
So, Mike, that's a good segue to kind of the second truth, which is that diversification matters more than almost anything. And we want to think about diversification again, not just within an asset class, but across asset classes and across investments. So, economic growth, the most pervasive risk that is essentially non-diversifiable, it's in almost everything. The other two big macro factors that drive almost every asset class are real interest rates and inflation. So think about growth rates and inflation as the three primary drivers of return across every asset class. Those are like the Lego building blocks you can kind of picture as the explanatory power for everything that you invest in. So public equities is basically one big economic growth bet. Private equity is more levered, so arguably it's economic growth with a little bit of rates in there because you are exposed to like the cost of capital to a higher degree. Real estate, for sure, you've got economic growth and then the exposure to real interest rates. If you think about something like inflation-linked bonds, I suspect that there's not a lot of linker investing going on here, but like for the sake of understanding the argument, linkers are essentially a pure bet on real rates. A nominal bond is real rates and inflation. And so we want to understand what is the fundamental risk that you're taking? Do I understand that? And am I being compensated for them? And ultimately, what are those diversification relationships? And I think this is a really important time to ask that question because those relationships are changing. For the last 20 years, when interest rates were low and getting lower, the best diversifier to your economic growth, where no matter where it came from, was a long bond. So every time there was a wobble in the economy, the Fed would come in, they would slam down rates, bond prices go up, and voila, you have a wonderful diversifier in the long bond. But 2022 really gave us a preview to what things might look like in a forward-looking regime that has higher rates and higher inflation. When inflation expectations spike, both stocks and bonds sell off. So actually, that long bond is no longer a diversifier to your equity portfolio, public or private. So what do we see institutions doing when, as they're looking for sources of diversification that are less correlated to economic growth, they're looking at things like real assets, infrastructure, market neutral hedge funds, again, things that have more exposure to rates and inflation as the diversifier, to earning an inflation premium, I should say, not the risk of inflation, to be a good diversifier to those things that are more highly levered to the growth cycle.
Okay. So
How
real assets meaning like real estate of some sort or that kind of thing, or something else. Okay.
Yeah,
Because
real
really, I
estate,
think of it as that's still dependent on economic growth, inflation,
it
and
is.
real interest rates. So,
It is for sure, but less than private equity, which is just
okay,
like growth on steroids, right? But at least
right.
in real estate, you do have real cash flows. You are being compensated for taking on that interest rate risk. So yeah, yes, you're still correlated to economic cycle. It's real hard to find things that aren't, but at least you're kind of tamping down the exposure there a little bit.
And I don't want to spend too long on it, but just like maybe a 30-second yes or no. So we had somebody on maybe 2 months ago that talked to us about uh, life insurance over, like the whole life insurance, that type of thing. Is
Mm.
something like that where it's not dependent necessarily on the interest rates, and it supposedly is returning some sort of a dividend, like a low dividend each year. Is that a diversifier? Or is that not any better than the rest of these things to get diversified versus like a money market or like inflation protected bonds or something?
It's a good question, and I am not an insurance expert.
Yeah,
However,
neither am I.
um, generally my experience is that the fees in those products, like the people who make money on insurance, are the banks and the insurance companies and not you. So
Right.
I am generally suspect of those structures because yes, they're giving you a stable stream of cash flows and they're charging you for it in the way that they bake in the spread to that
Okay.
policy.
So the key, so your a quick answer would be not an expert, fees too high to probably warrant it
Be
being a good
suspect.
buyer.
Yeah.
Yeah, against other
Yeah,
things.
be
Makes
suspect.
sense.
And I see in the chat litigation fund. Yes, great example of like totally not correlated, or like catastrophe bonds, totally not correlated to the strength of the economic cycle. So that's a great way to think about like what are things that just pay off in a different environment when there's a big recession or a big inflation spike. What are the things that might actually pay you? Now, the challenge is you want a diversifier that still has a positive expected return. So there's lots of protection strategies. You can buy protection, but it's like buying insurance. You pay for it. And ideally, as an investor, you want something that earns a positive expected return over the long run and provides you diversification benefits. And that's
it
harder to find.
so I have that opens a whole question for me, and I'm always sort of pulled into where the terminology in the industry has gone completely whack. And if you think about a hedge fund, the core definition of a hedge fund isn't it to achieve exactly that? Like people think hedge funds outperform the market, but the goal of a hedge fund is when the market goes up, it doesn't go up as much. And when the market goes down, it doesn't go down as much, right?
That depends greatly on the hedge fund. If you take the return stream of, for example, the HFRI index, which has like every hedge fund in it that reports itself, the correlation to equities is like 0.7. So like it's not a great, like the average hedge fund is not awesome. But hedge fund is sort of this grab bag of what do you mean by that? There's lots of different kinds of hedge funds. A hedge fund mostly just means like it sits in the Cayman Island and charges 2 and 20.
But
What you want
shouldn't it do
within a
hedge?
hedge
Shouldn't it
fund,
hedge? It should hedge the
don't you
market.
want it to hedge? Yes. What you want is something that's truly market neutral, that is long and short, with a very low exposure to net equity movements. Now, there are also some multi-asset hedge funds which are designed to have low equity exposure, low rate exposure, so that they're taking kind of cross-sectional bets. They can do, they're long one equity, short another equity. They're long one bond, they're short another bond, with no net exposure to any of those asset classes. So if the total asset class goes up and down, it doesn't matter. It matters if you're short Japan and long Europe, like you want to get that spread Right. And that is very uncorrelated generally with the average level of stocks and bonds. So the right hedge fund can be a great source of diversification. But there's lots of hedge funds that are basically just taking levered equity bets or levered carry bets, and that's not a great source of diversification. They'll charge you a lot for it.
But assuming
Long
Makes sense.
short crypto hedge is ideal. Long short crypto hedge scares me, but sure, probably uncorrelated. Although I think what we've seen in action over the last year or so suggests that crypto is more correlated to, I think, overall sentiment and kind of market fall than one had previously hoped. The speculation a few years ago when it was just coming out was like, oh, crypto is going to be not correlated with the global economic cycle. It's going to be not correlated with like whether the Fed hikes or not hikes. And it does its own thing, but it doesn't always do what you want it to do in terms of like not reacting to broader market sentiment. So
Yeah,
maybe
it
not for the
doesn't
faint
quite
of
seem
heart.
like digital gold yet. It seems
Yeah,
more like
not
a
yet.
little bit of that, but more that it's a levered bet on the economy and where it's headed, and sort of like risk on, risk off almost is what I've seen.
And that's right. And if you sort of go back to think about who's using crypto and what are they using it for, what are the fundamental risks that you're being compensated for? There's a ton of speculative. There's people who want the digital gold. They want to store a value. They want to be off the global financial rails. That's the part of it that you think should be digital gold. But there's also a ton of speculative investors who are going in and out along with market sentiment. And that's the part, those are the flows. They're going to be more highly correlated with just broad equity movements.
would an institutional investor like BlackRock build its own hedging strategies, or would it invest in other hedge funds that have proven their strategies that really work to hedge the market?
Both. So the largest hedge fund business at BlackRock are what we would call the direct hedge fund business. It was about $50 billion last time I looked. So there are equity long short funds, fixed income long short funds, macro funds that are kind of, again, trading across asset classes. There's also, I can't recall how big it is. There's also a fund of funds business at BlackRock that's doing exactly as you say, go and finding the great hedge funds out there. One of the things that's a truism at BlackRock is like it's a big company, their clients are big, they need to deploy a lot of capital. So if you don't have $10 billion in capacity, like BlackRock doesn't want to do it. And there's a lot of great investment ideas that you just can't push that much capital through. So a lot of what the fund of fund business is for perhaps smaller clients that are trying to deploy $5 or $10 million. They can invest in some of these great smaller hedge funds that do truly have some proprietary insights and history in delivering alpha, but just at a smaller scale and not something that BlackRock would ever do.
So I've heard the idea that if you have 20 uncorrelated investments, you're totally diversified, and it's kind of like the holy grail. The problem is actually finding 20 things to
Finding
invest
those
in that are
20.
uncorrelated. And especially when you start talking about economic growth, inflation, and real interest rates, that to me, that's at the backbone of almost everything I'm investing in. And so it's like so are there things that I'm not thinking of? Because I feel like I'm uncorrelated because I'm getting into, businesses and multiple types of real estate and loans and all these different things, but they're all tied to those three things.
They're all
So
tied to those
are,
three
are there
things.
are there any other sort of things, or does it not? Is that just one of those things that's like you just try to get diversified as much as you can, but you don't worry about it because you can't really get away from those three?
You can't get away from those three. And in some ways, you don't, I mean, those are risk premiums. I think about it as a risk premium because it is undiversifiable. Someone will pay you for taking on uncertainty to the strength of economic growth or the level of interest rates and the pace of inflation. You earn a premium for doing that. So you want those risks, but you want to know how much you have and in what proportion. Most of us have way too much growth risk. Probably 90% of the variance of your returns are dominated by economic growth. If you're adding in a little more of some of the other ones, you're just giving yourself a smoother ride. You're going to have a better outcome in more environments if you can make it a little more balanced. One of the ways that institutions do this is through leverage. So you can take something, a low returning asset class like fixed income, and you lever it up so that like the amount of risk that you're taking in fixed income and rates or inflation is more commensurate with what you're doing in equities, which have more internal leverage. They just have a natural volatility that's higher than public market bonds. And so there's this whole category, Bridgewater, you probably heard of. There's a whole category of these kind of very well diversified all-weather funds, which are basically trying to do just that. How do we find these fundamental risks and then try to balance them the best we can? You're not going to get away from them, but you try to achieve more balance.
Mhm. And when we're building a portfolio, I see sort of two thoughts, and I think I know what your answer is. But I see some people that they say, okay, I want to return, say, 6%, 6 to 7% cash flow, and I want to have some growth on top of it, and that's sort of what I'm looking for. And what they end up doing is, and everything that they invest in sort of like hits that general buy box. And my
Mm,
concern with that is that when you go about it that way, you build a lot of things they all kind of look the same, that you probably have a lot more risk than you would think, because it's anything that's returning that is probably very quarterly. Like I've met people before who had 20 different investments. They felt what they were diversified, but they were all multifamily value add deals.
mhm.
And they're like, oh, I'm totally diversified. I have less than 5% in every deal. And it's like, yeah, but you have everything in one type of thing, which to me isn't diversified and seems super risky. But at the same
Exactly.
time, if you're building something that you're trying to get to that end goal, but you've got some stuff that's growth only, some stuff that's cash flow only, and that kind of thing. That's what I do. But what's your thought, and what's the robustness of that, and how should we best think about it from a really institutional level of like being really diversified?
I think about it exactly the same way you do, that you might have some that are at 4 and some that are at 12, and you're going to get to where your bogey of whatever 6 or 7. You might
Yeah.
have to have more things at 4 and only a couple things at 12, because you have to put more capital in the lower risk things to get to balance. And that's, I think, what can feel uncomfortable to people, is to really think about it through a risk lens, not just a capital lens. How much risk am I taking, and how do I try to balance the risk that I'm taking to that level? Because I think you're exactly right. Anything that's paying out kind of about the same level, if it looks like a duck and sounds like a duck, it's probably like a duck, and they're all going to underperform at the same time. So you'd have a better outcome if you were willing to accept something with a 4% yield, and then you took a flyer on something with a 10% yield.
Yep.
I think
Okay.
I think as well, like if you look at the past year or so at privates versus publics, the private markets have an inherent, I'd say, risk, which is maybe a transparency risk as opposed to the public markets, but you weren't getting paid the premium for the risk you're taking. And that's why you saw a lot of people moving back to the public markets over the past year, because they weren't getting paid the premium for the risk they're taking in the privates. And it is really interesting to look at it from a risk lens perspective.
I think this is one of the most interesting conversations around like liquidity premium. I think the liquidity premium, like a couple of things. Like I think liquidity is often like the catalyst for all crises, where you have a mismatch between the fundamental nature of the underlying investment and the fundamental nature of the person that's buying it. Like when those two things are not aligned, things go poorly. That's, if you think about the quant crisis, the failure of Silicon Valley Bank, the global financial crisis, this was all things that like fundamentally were mismatched between the assets and the liability. And what you're describing that we're seeing today is so, both institutions and individuals have really flooded private credit and private equity and venture. If liquidity is essentially a supply and demand premium, it's not clear to me why you would earn a premium for being a liquidity provider when liquidity is abundant. You earn a liquidity premium by being a liquidity provider when there isn't any. And so you think about what's happening in private credit today. First, we have this mismatch that we talked about. People have been putting fundamentally not liquid loans into a quarterly traded vehicle. That's fine as long as nobody wants their money. And then when everybody wants their money, it's a problem. It's a problem if the fund sponsors have to sell those loans at disadvantaged valuations, and then it's a problem for even the people that didn't want their money because they're incurring losses on those books. So the gates are actually what you want to see. The gates are there to protect the existing fund holders, to make sure they're not forced sellers of any of those loans. But if all that money is flowing into private credit, why would you earn a premium compared to public credit if suddenly they're awash in money? Where I think people are now earning a premium is because redemptions have been elevated. Guess who's stepping in to provide liquidity in a tough time? Saba. BlackRock, Saudi Arabia, like all the big institutions are coming in and being liquidity providers in this environment where there was a bit of a crunch. That's how you actually earn a liquidity premium, is by being that like lender of last resort when there isn't any money in the system. So I believe there's a liquidity premium. I'm not certain that being a long run investor in private equity is how you earn it. I think there's a sourcing argument. Either you are great at finding deals and opportunities, and so that's an alpha opportunity, or you might argue that there's value that's added way before a company goes public and you want to participate in that. That's sort of a expanding the opportunity set argument. I'm not really sure it's a liquidity premium given the world today and how much demand there is for private markets investing.
Interesting. What do you think is the future of private credit then, under that assumption?
Well, why people like private credit is that you can earn 12% on a bond. And hey, that sounds great. Let's rewind back to our diversification conversation. Credit is correlated to the economic cycle, but less so than equities. You think about the Meta announcement this morning, they're trading down in their equities, but they're not going to default on their debt, right? So the stock market could be looking forward to a slower level of earnings or a recession, but the credit market is still holding up okay. So you do sort of see some separation between the price movements of credit and equities, even though of course they're still levered to the economic cycle. So what's exciting about private credit is that you can actually earn a double-digit return while taking on less economic risk, and obviously there's some rate exposure in there too. So it is a form of diversification. It's a higher return form of fixed income investing. And I think that's why people like it. And look, I own some private credit in a BDC by a certain cerulean raptor, if you want to use a code name for for their fund provider. They, not the one that's gated. So like I like it for the risk return trade-off. I have no intention of tapping it for liquidity. My biggest concern is that they get into a position where they're forced to meet redemptions when they shouldn't. And so again, the gates are what I want to see. It means that actually they're standing up to what they should.
I have a question before we move on to the third truth, which is liquidity, and maybe we've already touched upon it a bit. But for a second on the diversification one, when you think about, because it's hard to think about a institutional like BlackRock. Sorry, I was about to say the bad word. Um, has products, and those products have a
Mm.
specific goal, and that
Yes.
goal might be, you can't achieve that goal if you diversify into others. You need to focus on a specific asset class. You might diversify within that asset class to achieve the goals of that product. And so when you think about diversification in that context, it's very different than holistic diversification, which most of us think about, right? You have your cash, you have your privates, you have your publics, and you have equities and debt within each of them. And then what's the underlying asset? That type of approach is very different to a product BlackRock is offering. Like if it's a,
Yeah.
you know, and we also talked about this in the pre-call. If you think about like an endowment, which is, I feel like an endowment is more similar to an individual investor in a sense where it has a pool of capital that it has to deploy and it wants to make sure it's not over or underexposed to achieve the goals of that endowment. And then going back to privates versus publics, those endowments are heavily invested in privates as opposed to publics, which you'd argue the flip side that large institutionals don't do. So that's like just a long spiel, but like, what do you think on that idea of diversification in the context of like a specific product?
It's a really great question, and something that we grappled with quite a bit as we thought about designing products. And my view was always that we shouldn't just take a great investment idea and develop it kind of in a vacuum for like, we think this is cool. We want to have a specific user in mind for an endowment or for an individual or for a pension fund. What is the challenge that they're trying to solve? What is its role in the portfolio? And you solve for that outcome. And then you're exactly right. If this is essentially a long only equity portfolio, my job is to be as diversified as possible with regard to the benchmark that I've been given within that particular opportunity set. That does not solve your diversification problem, but hopefully I've given you a tool that is useful in that total portfolio exercise. I think what's not useful is to try to design a tool and then give it to you when like it actually doesn't do, it's reverse levered, or it doesn't actually help you solve the problem that you have. So from a product design perspective, we always want to be thinking about who is the client and how do we provide them with a tool for their toolkit. Now, there are many teams at BlackRock, including the outsourced chief investment officer function, as well as things like the retirement team that delivers 401k, target date funds, that are thinking about that total portfolio problem. How do I put the pieces together? And BlackRock's risk and portfolio management system called Aladdin did a lot of work, both for internal and external investors, to try to help solve that problem. How do these things add up across asset classes for things that you don't usually put next to each other? How do we have one risk model that could actually add it up across everything and get that total portfolio view? So a lot of us spent a lot of time thinking about how to add up across those asset classes, even if individual products were designed for only a subset of that portfolio. You mentioned endowments. I think they are, perhaps the closest corollary, although again, like no taxes. Endowments look a lot different than other institutional investors, namely because their liability and cash flow needs are so different. If you're a pension fund, you have to pay out a stream of income to your participants every year. And so their job is to defease that liability. How do they match the assets with the liability in a way to maximize the probability that they're going to be able to meet those liabilities as far out as they can forecast? If you're an endowment, you're sitting on a couple $100 billion of permanent capital. So they have a much longer, in some ways, infinite time horizon. They can be significantly more invested in private markets and illiquid assets, the infrastructure, the real assets, the timber, the catastrophe bonds, like all those things that are a little bit more nebulous because they don't have those discrete liquidity needs in the same way that a pension or a retirement plan would. And so they tend to be much more focused on the illiquid because they can be.
Okay, let's change gears here and move over to the third one, which is the liquidity truth. And we did touch upon that, but let's dive into that. And I will just mention again, if any of you guys have any questions or topics you want to dive deeper into, please unmute yourself, ask, or put it down in the chat. Sarah, what do you think about liquidity? Because I've always looked at liquidity as you know, there's advantages and disadvantages of liquidity, especially for private investors, not necessarily for institutional ones, because there's a psychological effect to being too liquid. You make bad
Mm.
decisions when you can make bad decisions, and you don't when you can't. So there's like a protection attribute to privates, which are non-liquid. But what do you think about liquidity in the
Mm.
sense of like structuring portfolio?
I hadn't thought about like the governance aspect because the way institutions protect themselves from bad decisions is they have really complicated and not flexible governance processes. So like it's really hard to fire a manager, right? Like it's actually really hard to make a tactical move in an institutional portfolio, and in some ways that means they can't go after every opportunity, but it also protects them from bad decisions a lot of times. So I think like having a plan and sticking to a plan to the extent that you can is really helpful. And in fact, like all the research about rebalancing says it doesn't really matter if you rebalance monthly or quarterly or annually, just rebalance. That's like the thing that matters most. So have a plan and stick to your plan, I think is actually one of the most important. One of my was like my fifth truth, I think that we didn't think that we were going to talk about. Um, the way institutions think about liquidity is often by trying to construct a very intentional waterfall. And I think that's something that we can take with an individual perspective as well, as to think quite intentionally about what are your near-term liquidity needs, what are your medium-term liquidity needs, and like what do you want to put away so that like you don't make bad decisions about it. You can take a longer time horizon. And an institutional liquidity waterfall looks like they've got some short-term cash to like actually serve, whether if it's a corporation or a benefit, like they know what they have to pay out in the next 6 months. They've got something like a short duration bond portfolio, which like you can sell it if you needed to, and it's not particularly it's not going to move around too much if rates move around because it doesn't have a lot of duration exposure. So like that's a great way to have like that second leg of liquidity. And then even the most alpha seeking investors often have like a big slug of public equities that are indexed in something like SPY or IVV because you can sell it in a heartbeat. Now, you don't want to sell it if the market's down by 20%, but you can. And you sure don't want to be a forced seller of things that are trying to take long run alpha positions or having to tap your hedge funds that are, that really are going to be disadvantageous if you have to sell them in a crisis. So having some well diversified and thoughtful liquidity waterfalls is a nice way to, again, try to give yourself the outcome that you need if you need money. And some of it is not just for emergencies, right? Like my kid's going to go to college in 18 months. Like I got to be able to pay your fees. Shouldn't have that tied up in something like my Cerulean Raptor fund that doesn't particularly have that kind of liquidity profile to it.
I,
Sorry, you mentioned a private credit that you happen to have a little bit. So something like that we have that say like 90-day liquidity potentially, but maybe not for sure. Where do you kind of put that into things where you're not trying to make maximum profits on it, but you're certainly trying to make more on it than you would a laddered bond fund or,
Yeah.
money market account or something like that? How does that factor into your liquidity thoughts?
I think of that as a long run investment. So even
Okay.
though I can
So you
get the
don't
money,
really do it.
I don't plan on it. No,
Okay.
I don't want to. The average life of the loan in that fund is like 3 years. So like at minimum, 3 years should be, you kind of sort of think about like it's refreshing itself on that cadence. I shouldn't think about tapping it within that time horizon. I actually think about it probably at even a longer time horizon than that. I don't want to have to tap that as a source of liquidity. It's earning more like a 10% yield instead of like the 5% yield that you would get in a public market bond fund. So it's doing its job from a leverage perspective and from a return perspective, but I've just, tied that money up for the foreseeable future.
Okay. And do you think is it so like for somebody like myself, I try to think of things where I've got sort of my permanent money that's placed that's it might be
Mhm.
2 years, it might be 10 years, but it's permanently placed. That I'm not getting a hold of. I've got my obviously my cash. I've got my sort of like money that I can get in like 3 days, like a money market, that type of
Mhm.
thing. And then I've got that next tranche for me is that 90-day. Typically it's not in a quarterly withdrawal fund, but I would think of it the same way. It's some sort of like a hard
Mm.
money loan fund or something like that that I can have, say, 90-day liquidity. But again, you never know if you're in sort of a crisis if it's going to be available or not. But I count that as part of my liquidity. Then I have
Mm.
one or two investments typically that have like annual redemptions possible. So it's like once a year you can ask for it and they've got 6 months to give it to you. So that's sort of that like medium zone thing. Am I irresponsibly thinking that I have liquidity when I don't in something like that?
I guess I think that's a very generous way to describe your liquidity. Like the opening cycle is not the same as the time horizon of that investment. And I guess I think about it more around like, what is the time horizon around which we think that return will materialize? It's a 3 year loan, it's a 3 year investment. If it's a long run alpha generation play, that's like a 5 year forecast, that's a 5 year investment, even if it's sitting in a daily traded ETF. Like I don't want to be tapping something that really is expected to have many more months and years to it to materialize that outcome that they're trying to deliver to me. So you can get it, but you might be asking at a time when it's either disadvantageous to take your money or there's a whole lot of other people that want their money too, and then you're not going to be able to get it.
Right. And that's more likely for me what it would be something shifted economically to where, like a fund that is making loans to flippers or to, short-term bridge debt to people
Right.
who are doing a value add on a multifamily property or something like that. If they all would have the same trouble of being able to refinance out or sell that property when they were done, then we could get stuck.
Yeah, you can get stuck. Yeah.
Okay.
I also say something about liquidity, and again, this is like my personal approach to it, is that sometimes it might seem liquid, but it's not really like the fact that your stock holdings are liquid is kind of it, it's not real. Like if the stock markets go down by 50%, 30%, 10%, 50, whatever, and the fact it's liquid, does it matter that it was liquid? Like I can if I own a property,
No, it's almost worse,
if I
right?
own a
Because
prop
you
but
don't want
if I own
to.
a property, if I own a property, then I want to sell it at a 30% or 40% discount, I'd probably get a cash offer within an hour. So is that liquid?
Mm.
I mean, like, I'm just saying, like, the fact liquidity exists from an actional standpoint doesn't mean it's real liquidity in my mind. There's always like some sort of premium you're paying to have that liquidity. And I think, just like what B just mentioned about, oh, yeah, you're overpaying to get some liquidity. You really
Yeah.
have to think about it all right, but when I need it, should I tap into this?
I think you're 100% right. I think it's a vocabulary problem where like we use the word liquidity and we mean how often can I put up a trade? Like how often is the fund open? Or we mean can I sell it when I want it? Or we mean does it price every day? Or do we mean yeah, so we use the same word to mean a lot of different things. And so mentally, I don't know, I think we should all just try to think one concept at a time.
Yeah,
That to your point, like cash flow is a different question than time horizon, than pricing frequency.
100%. Yeah. Um, are you expecting to find opportunities in the market now? And obviously the full liquidity is having cash to go and take opportunities. Are you, what's your personal approach to the moment with where we're at?
So I'm of two minds, and which sort of describes my investment outlook in most environments. But on one hand, it feels like we've been in this late cycle economic environment for a really long time. I don't know how long we can tolerate a dollar, $120 oil prices without that having a real impact on the price of a lot of things, which is really bad for economic growth. So I'm worried about what's going to happen in the broad economic picture over the next 6 to 12 months. At the same time, I live in the Bay Area. And so, you can't swing a cat without finding a pretty amazing opportunity with some startup that's working on some AI infrastructure or AI investing. There's a lot of investors that I know that are now kind of thinking about how they bring artificial intelligence and agentic processes into the fabric of everything that we do in the industry. So there's so much that's fascinating that's going on. I think there's some great investment opportunities. I think we just have to be a little bit skeptical that the good times are going to continue, both in terms of the cost of capital and in the strength of the consumer in particular.
How is that going to affect the markets in your mind, the public markets?
$120 gas is not good for equities. Like that can't be good for equities. So I mean, that to me is recessionary. And if there is a prolonged closure where there's just no supply chain, there's no oil that's moving around the globe, there's damage to energy infrastructure, there's likely to be an extended period where the cost of energy is higher. And that kind of compounds the effect that already has, like AI is outstripping demand for all of the energy that we have. Like it's a hugely inflationary problem. And we already talked about like inflation's bad for stocks and bonds, right? Inflation's kind of bad for just about everything out there. So like that's the voice in my head that makes me concerned about just about anything that's publicly traded, is like inflation risk is real. And it's a really bad outcome for most investments. Like as you're sitting with your investor hat on and you're thinking about diligencing potential opportunities, what are the things that can withstand an inflationary shock? Like that's a great place to focus your attention.
What do you think is causing the markets like today we hit a new all-time high, which to me makes zero
It's
sense.
crazy.
This
Yes.
entire bounce back that we've had when with the supposed, the strait was going to open up and this and that, and then we just like took off like a rocket and went up 20%. It's like it makes no sense to
It's a
me.
little tough.
What
I
obviously very
personally,
smart people are out there investing that
real
don't
smart
agree with
people.
me.
Yeah.
But I can't understand their thinking. What do you have an idea of what it is?
The only explanation that I can see is that ultimately fundamentals still look good, right? Like Google still had a hell of a beat yesterday, right? So like and most of the companies that have reported in the S&P 500 for this quarter have beat expectations on both the top line and the bottom line. So it's not just revenues that are increasing, but like margins are increasing. So like, gosh, it sure seems like the economy is ticking along pretty well. So I don't know that the market is yet looking through to what is the long run macroeconomic impact of higher energy prices, higher inflationary environment. And you could argue that that's reasonable because it is so hard to predict. And if you can't predict it, maybe you don't. Overall, I think the market has a very optimistic outlook to it right now. And so all the news is interpreted with like, oh, we're already in a good mood. And so we're not going to worry about what happens to the $120 oil because we'll worry about that down the road. I worry that that's going to come back to bite and things are kind of priced to perfection right now.
And are you doing anything personally or recommending people do anything to adjust for that or being more conservative? Or is it just sort of like you have your written plan and you just stay with it no matter what the market's doing?
I really try not to do much, especially in a time like this where like I don't know what's going to happen, right? Like I have no magic ball to say when the Strait of Hormuz is going to open. So why would I take a bet on that? My best advice is like, yeah, you should be diversified. And so if I was happy with the diversification in my portfolio 6 months ago, based upon my risk tolerance, my time horizon, when I think I need the money, I don't really have any reason to change it now. So no, I'm not doing much, but I also, I would bring that lens to any new investments that I am considering. How would this business withstand a more challenging economic environment and arguably a higher inflationary environment and higher cost of capital a year from now? Does this story still hold true when the times are less rosy?
I think, in light of that and the fact that you are in the publics and the privates that you talk about are mainly high risk startup type investments, what about real assets like real estate as a hedge against inflation? Obviously, it is also
Yeah.
affected by interest rates. But if you think about it, inflation, how owning hard assets is a hedge against
Yeah,
that.
I like it. Yeah, I like it. I think real assets is absolutely, and even to some extent, commodities were a desert for 2 decades, right? Like commodities are another good general kind of inflation hedger. Yes, some are very correlated to the economic cycle and energy in particular, but you could look at a basket of commodities, which is less economically sensitive or more store of value and diversifier. But yes, I think like real estate, real assets are a great place to look for opportunities, particularly things that have kind of fixed cash flows that again might be a little bit less reliant on the pace of economic growth would be a great place to deploy capital, in my opinion.
So you have two additional truths that we mentioned, and we haven't dove into them. One of them we kind of talked about. The other, it's maybe worth saying, that the future will be different from the past now more than ever, which is one truth. And the last truth, which is having a plan, sticking to it, which is what you just mentioned in your approach, which you walk your talk. What let's just touch for a second on the future will be different from the past, because obviously, it's very trivial to say that, but what do you mean by that? That's sort of like adding a new approach to it.
I think that most of us have spent our adult lives in an environment where interest rates were low and falling, and where the biggest risks to your portfolio were a growth shock. There's a recession, there's a downturn in the economy, and so you have to live through that. And then your friend, the Fed, comes in, cuts rates, bonds go up, eventually equities go up. You have this like kind of growth cycle, and the Fed has actually gotten really good at narrowing that growth cycle. Growth shock we know how to handle. Inflation shocks are much more dangerous. They're much more challenging to deal with. Inflation goes up, the Fed cutting rates does not help inflation, right? So there's nothing that you can do but keep rates high to fight inflation. I mean, that's really, really painful. And so living in this environment with higher interest rates, higher inflation, where I expect that we will continue to be for all the reasons that we've talked about, is just fundamentally a different climate for capital markets. The cost of capital is higher, diversification relationships are different. I think cycles could be more prolonged again because you can't just like grow your way out of it. I think it's potentially a very different environment to be an investor. And then I think like my last caveat on that is like probably the future will be different than the past in ways that we cannot predict. You know, 3 years ago, I think very few of us would have suspected that SaaS software would be like hugely vulnerable to agentic AI. Like things are happening so fast, it's really difficult to predict what areas are going to be vulnerable, what areas are going to be the winners. There's a lot of disruption that's coming. So what does that mean? Diversification. And then like to some extent, yes, you should have some dry powder. Like you want to be looking for those great opportunities just with that forward-looking mindset.
So with the if we have inflation, so like the last time we had inflation, in my opinion, it seems like it was more of a demand driven. There was money came into the system, demand
Structural.
was up.
Yeah.
Yeah. And so therefore the inflation was there because we had more money to spend, we were spending more money. So therefore, raising rates made sense to slow things down. Right now, if we get inflation, what I'm guessing it's going to be due to high commodity prices, high oil. It's not really a demand problem, it's a cost of everything problem.
It's a supply
So
problem.
so it's
Yeah.
not really, so on one hand, I could see, okay, the only thing you can do to fight inflation is raise rates, but at the same time, I could see the Fed saying, hey, you know, inflation's up, but actually the economy is being hurt, and there's already this inflationary thing causing the economy to go down. If anything, we need to lower rates to sort of like help the economy stay up to deal with the inflation. What do you think the chances are that if we do get that sustained $120+ oil and it really starts to tick up inflation, which it would, are we looking at most likely raising rates because you're just trying to fight that inflation number, or does the Fed actually keep rates the same or lower because they're trying to keep the economy going in the face of higher expenses because it's not a demand focus or
I'm
demand call?
certain that there will be some Fed governors that argue on both sides of that.
Yeah,
Because I mean, inflation is really, really tricky. I think it's hard to argue that you should cut rates because that's clearly inflationary, and you do need to the extent that that growth, you don't want runaway growth at a time when you have inflation. Now, high oil is already slowing growth, so like you don't need to worry. I think about raising rates, but I think the prospect of a cut is becoming less and less likely the more you're seeing persistent inflation. And the Fed has this weird dual mandate, right? It's the only central bank that has this dual mandate of both inflation and growth that puts it in this kind of rock and hard place situation where they're really trying to ensure that the economy is still growing. But to be honest, inflation is way more dangerous. Like you know how to cut your way out of a recession. You can't cut or hike your way out of inflation. It's very much in the minds and the expectations of the public. And so I believe that Chair Powell would have continued to be very, very hawkish in the face of this environment. Like we'll see what happens with a new Fed governor. The biggest existential threat, I think, is a non-independent Fed is a disaster. Like that is like, if there's one thing that keeps me up at night, it is, will we have an independent central bank? Because the fastest way to hyperinflation is a central bank that cuts when it shouldn't.
right.
Yeah, that's always been the case, right? With the Fed, though. There's always been that conflict between government and the Fed. And
I don't think there's ever been a time where there's been more concern or pressure on the Fed politically than there is
I think
now.
it's
I
much
can
more
think.
public. I just read a book
That's
about,
probably true. They were
yeah,
probably like kvetching behind closed doors
yeah,
and not on
Versus
Twitter or
tweeting.
X. But yeah.
yeah. Um,
I
uh,
feel like I've taken us to a cynical place, and we should end on a happier note, which
Yeah,
is
yeah,
that there
that.
are really exciting investment opportunities that are out there. There are a lot of really amazing things that are happening, and I do think, like with eyes open, there will continue to be many opportunities to generate returns.
for sure.
And is anything specific that you're looking at, Sarah, or adding to your portfolio this year?
Well, like I said, I live in the Bay Area, and so there's a lot of fintech startups in my neighborhood, and so I spend a lot of my time there professionally. And so those are kind of the opportunities that have been crossing my desk that I find most interesting. And while a lot of them are AI related, I also am interested in some things that are maybe not AI related. Like I don't want to put all my eggs in the AI basket. And if anything, I think some of those companies are starved of capital because so much venture attention and investor attention is going to things that are focused on AI that are actually looking at some boring remittances apps, things like that could actually be a nice way to like think about technology and the future of technology in a way that's not quite so AI focused.
Right. A lot of times you make money in the non-sexy stuff.
It's the not sexy stuff that ends up actually paying you. It's so true.
Yeah.
100%. Sarah, this has been awesome. And we're going to share your contact info because you agreed to that with everyone afterwards in the recording.
Yeah,
And
happy to.
if anyone wants to talk about the future of money, investing, or any opportunities, feel free to reach out to her afterwards. It'll be in the recording information. This has been really great. Thank you so much. Super interesting stuff. Thank you all
It's
for
a pleasure
joining.
being here.
Yeah. Lovely to talk to you, Sarah.
Have a great rest of your week,
Thanks,
guys.
guys. Have a great afternoon.